Right. So that's an essential part of this. So if you've missed out on the HTC training in the past, remember, what I've done now is just very quickly revised how to define whether you where the HTC channel is. It's really quite simple once you get into it, but much more important for us is to get into looking at the WM patterns. And as I mentioned as well, it is kind of an introduction to that because we've started looking at these four-wave patterns. And the four-wave pattern is essential in being able to determine an HTC channel. And obviously, it's also the basis for our WM patterns. So again, if you need some revision on the HTC channels, then all of that training is available in the Academy. Okay, we've got extensive training on that. And if you also go through that training, of course, you can ask any questions you want in those modules. There's space for questions there. So remember, you're welcome to do that as well. All right, so that was just a very quick recap then. Again, we've just been galloping quickly through how to determine the channels now. We've looked at price action, we've looked at the elements of price action, how we use those elements to determine the start and the end of waves, which is an essential first step in determining whether we have a trend. That question, do you have a trend, yes or no, is so important to be able to answer. We answer it by saying, are we inside of a range or not? If you're inside of a range, you can just assume that you're not in a trend. How do we define the range boundaries? Well, we've got these two methods, the LPO method and the HTC method. You can use them together because they both have a weakness, but by using them together, those weaknesses can't cancel out. And you're looking for a breakout. As soon as you've got a breakout, as we had over here, then you can assume that you're in a potential trend, and potential trend can either turn into a false breakout. And that would have happened, by the way, if in this case, the market had not only come back here, but we'd had a breakdown in the sequentiality of cyclicity. So here we've got phase one, phase two, phase one. But what if we had phase one, phase two, and then pull back? Then obviously that would be a false breakout. But the opposite of a false breakout is an established breakout, which is phase one, phase two, and a second phase one, at least outside of that preceding range or channel. So that allows us to answer that question. Do we have a trend? Yes or no? In this case now, yes. And then once you've got that, you can say, you can start looking at, are you in a phase one wave, phase two wave, and how do you use that, especially when you're using multi-time frame analysis, and we're going to get to all of that. All right, so again, quick gallop through that. But that does now allow me to be able to start moving forward into our discussion around the WM patterns themselves. So I just want to quickly double check to see if we have anything here. Doesn't look like it. All right, so it's all good. Just to reiterate, there's HTC channels. We're going to be looking at WM heuristic patterns, also known as XABCD patterns. Now, why do we call them that? Well, XABCD comes from harmonic patterns, and it's something that I used to use a lot. Things like Gartley patterns, BAT patterns. There's a whole range of them. Butterflies, we only really used to trade Gartleys and BATs because for some very, very good reasons, which we can get into another time. Harmonic patterns are very interesting, and we can even touch on that maybe if we've got time in our VIP sessions. But really, they all are made up of four-wave patterns, and four waves have got 5 points. If you look at the start and the end of each wave, if you've got 4 waves, you've got 5 points, including the floating point, which is the end of the, or the fact that the last wave hasn't actually come to an end. It's where it currently is at, basically. So you've always got 5 points, and we name those points X, A, B, C, D. And ABCD patterns are quite well known in the market as well, and not to be confused with labeling the waves. So if you are an Elliottian or an Elliott wave trader, then it could be a bit confusing because there you label the waves and not the points. you'll have waves 1, 2, 3, 4, and 5, and A, B, C. You're not labeling the points, you're actually labeling the waves. So just to clarify that and make sure you don't get confused, at this point in time, with these exercises that we're doing here, we are looking at labeling the points. Okay, so again, we've got the basic training in the academy for this, so you can go over it. Now, I'm going to spend a bit more time with you guys on this as well, because I know many of you haven't gotten to this as yet, but at least just to encourage you, remember that you can go back and look at this both here and in the advanced training. But I did want to delve into it. We are looking to delve into the stuff now in some more depth today and of course tomorrow as well. Okay, so let's in fact jump to the advanced training. You'll notice under advanced training, we've got the multi-time frame analysis section. And by the way, if you're wondering why there's all this other stuff over here, it's because I'm the administrator and I am developing other material for you guys in the academy, which just isn't ready yet, as you might have noticed. All right, so looking at our multi-time frame analysis, which is an essential part of this. I'm not going to jump into that just yet, but the WM patterns are the substance, the foundation of being able to do good multi-time frame analysis. That really releases the power of multi-time frame analysis. If you are not using the WM heuristic patterns, you're missing a lot of the benefit of multi-time frame analysis. Okay, so I'm not going to necessarily, I say this is under construction, but it's basically done. I'm going to jump straight into the WM patterns because I want to talk about how we classify these wave patterns and where these classifications come from. Now, I don't want to get too stuck on the theory, but we need to cover it. And I am going to do that now, basically for the next half an hour or so. And then once we've had a chance to have a break for a bite to eat for lunch, we'll come back and apply it a bit more practically on the charts, as we have been doing. All right, so now starting off with W patterns, I don't really necessarily want to do that. It's important to realize that when a wave comes to an end, you will immediately switch from, if it's a bullish wave, when your bullish wave comes to an end, it means you're flipping from a W pattern to an M pattern. And when a bearish wave comes to an end, and here you can see X, A, B, C, D, okay? So if we were looking at this class one, case one, class one, these days I call it class one. When you see that D fixed in stone by obviously a ringed low, and this wave, bearish wave having come to an end, that D will become C, which means that A will become X, B will become A, C will become B, D becomes C, and then we have a new D. But not only that, it will flip from being an M pattern to a W pattern. And that's something that folks have sort of, it's stymied a few folks in the past. I don't want it to do that for you, okay? Just because we have defined them so separately over here doesn't mean that practically that's how it actually works. And that's why I want to spend time with you today and tomorrow and possibly next week as well on this as well, where you can see how it flips from one to the other. And just now, in fact, when we were going through, when we were looking at those HTC channels, you could see me flipping the wave forward. It was like leapfrogging forward. And as I did that, we were flipping from a W pattern to an M pattern and vice versa, okay? So that's the first thing to realize, is that whenever a wave comes to an end and a new wave starts, you are flipping either from W to M or M to W. And that's not a big deal. It's really not important. And these different patterns are related to each other, okay? So for instance, when a class 1M pattern, as it comes to an end, it will initially flip to being a class 4 W pattern. One thing I need to clarify here, folks, and in fact, I need to update this in this training, and but that means I'm going to have to redo these diagrams. And Greg, I'm glad you're here, because otherwise you would be pulling me up very quickly on this, because we've had this discussion before. I've decided to change the name of one of these classes, and the fact that class 4 up until now has been at any point in time where if it's a W pattern, looks like this, where you can actually see that B is below X, but more importantly, C is below A. Now, a class 4W pattern is one where we do not have D's closing encroaching on A to B. You'll see this in a bit more detail. If this is new to you folks, don't worry about it. I'm just pointing it out now for some folks who are more experienced with these patterns and would otherwise be giving me a hard time. So a class 4 is like an upside down class 1, or it's when you've had a class 1 pattern that's gone, let's say, from an M to a W, and we do not have any sign of weakness yet. As you remember earlier when I was talking about a trend, it's a consistent breaking of support. So we would have seen the support level at A was broken by the BC wave, and with that close below, but we're also expecting that support to turn into resistance and be respected as such. Excuse me. So it just goes back to the definition of a trend. Respecting, beg your pardon, a consistent breaking of support and then respecting of that support as resistance once it's broken. So if it doesn't, and the market comes back and closes inside AB, that would then be, or above A, I should just say, if it closes above A, we're going to call that now a class 5, okay? So that wasn't what a class 5 was before. We're going to now call that a class 5. So a class 5 and a class 2 are related, and a class 1 and a class 4 are related, as you'll see. So I'm just putting that out there initially. This will all become much more comfortable once you've been able to apply it. All right, so let's look at what they actually mean. And I'm just going to take it step by step, and this is probably where you're going to start thinking of questions and maybe start feeling like you're a little bit confused in certain areas. So please don't hesitate to pop questions into those comment boxes on the Facebook group. Okay, so a class 1 pattern is effectively a strong trend. Now, if it's a W pattern, what are we seeing? We're seeing that, first of all, wave AB is a phase 1 wave that broke and closed above point X, which is the preceding wave high. So as we were looking at earlier, when we were classifying our waves as class 1, as phase 1 and phase 2 waves, you'll notice that this is a phase 1 wave because, and I'm assuming it broke and closed above X. That's what it's showing here. We also then had BC, wave BC, which gives us point C coming down and closing above X. In other words, we did not get a close inside or below X in this case. And once that wave came to an end, it means that it was a W pattern, giving us that as our point C, and therefore D would be floating at any point over here. In fact, right now it would be where that price level would be, with this going up and down on that bar. So this would be an incomplete wave. However, B to C, C is ringed, and the lowest close between B and D, in fact, the lowest close is above X. That would be a class 1 W pattern. And you can actually see it here, where you can see all of these lines, X to B, X to C, and A to C are all upwards pointing. Now, these are also all closes, by the way. Okay, really important to note, because even if C came all the way down the point C and went below A, that would be fine as long as the lowest close is above X. Okay. You'll notice that class 2 doesn't have that. The only difference here is what I've just described, where the lowest close between B and D is in fact below X. So if you look at these lines, X to B is still pointing up, A to C is pointing up, but X to C is now pointing down. And that's C close. That is C close. It's not point C. Point C is down here. That's irrelevant. It's C close. The lowest close between B and D effectively would be, needs to be above X in order to be class 1. But if it fails to do that and it's below X, but in actual fact, but above A, it would then be a class 2. All right. I would like to point out, however, if C closed was also below A, that would be what we call a class 6 pattern. We're not going to worry about that now, but I know that that's what Greg would be asking me otherwise if I didn't answer. Okay, so in the past, we didn't worry too much about it, and I still wouldn't worry too much about those. We don't need them. They're really just showing really a huge amount of chop in the market. When you've got phase one wave, and the waves are getting wider and wider, it's the type of market you want to stay far away from. Okay, so that's a class 2. What about a class 3? Well, you can see now it's starting to get a bit simpler. Class 3 is where wave AB, and again as the close, is inside the dimensions of the XA wave. So you've got XA, whatever that might be. It doesn't matter if it's a phase 1 or phase 2 wave, but now A to B is no longer phase 1 wave. It's a phase 2 wave. In both class 1 and class 2, AB is a phase 1 wave. And that's not just the high, it's also the close. So even if we had a bit of a higher high over here with the candle spiking out, but the close was below, we'd still classify this as a class 3 pattern. And now you can see that of these 3 dotted blue lines, we've only got one that's still pointing up because C close is still above A. Regardless of where C itself went, the lowest point in wave B to C, the lowest close between B and D is still above A. But B close is below X now, and of course, C close is below X and above A. So we've got these 2 downward pointing lines, but one of them is still pointing up, which leads us naturally now into a class 4 or case 4 pattern, which is still W, but now everything's pointing down. Okay, so B is now also still, as it was with class 3, below X. And of course, it would always be above A because that's a bullish wave. But now C, unlike all of these other patterns, C close is in fact now below A. All right, A being the actual point, the lowest price point. So it would be the bottom of the candle or bar, the lowest point in the, well, lowest point, in fact, between X and B is point A. So you need to get a lower low, lower close on C, C's close below A with a lower B as well. And then you have a class 4 pattern. Now, just want to reiterate what I said at the start of this is what will also now be important in determining if it's a class 4 pattern is D's close, the highest close in the CD wave, which is still incomplete, must be below A. It's starting massively apparent here in this particular diagram, which is why I need to redo it. But the highest close in C to D must be below A. If it's not, it is not a class 4 pattern, it's a class 5 pattern. All right, so that's pretty much it for the W patterns. M patterns, it's the same, it's just upside down. And it's often easier just to draw in these little dotted lines, A to C, X to C, X to B. And you'll notice in a class 1, they're all pointing down. Class 2, 2 of them are pointing down except for X to C. And you just remember X to C and you'll be fine. Class 3, you've got all except 1, which is X to C, pointing up. The other 2 are, I beg your pardon, we've got AC pointing down, and now X to C and X to B are pointing up. And then in the class 4 and class 5, they are all pointing up, but the difference between a class 4 and a class 5 is that the lowest price point in, or lowest close, I beg your pardon, in C to D is above point A. So it's still a higher close. That would be a class 4, but as soon as we get a close below point A, it becomes a class 5. And folks, that all goes back to our definitions of cyclicity and support and resistance, and definitions of a trend in terms of these elements of price action. In terms of a bullish trend, if it's going to be a strong trend, we would expect once resistance is broken, for that resistance to be respected as support. And if it's not, it's a sign of weakness. Now, a class 4 and a class 5 pattern is part of a bullish, M pattern, I beg your pardon, is part of a bullish trend. So if we were looking at a class 4 M pattern here, and as soon as CD comes to an end, and remember at point D, the lowest close in CD would need to be above A, assuming that that is the case, that's just in this little section here. If we get that, and we now get a new CD pattern starting, what do we have? It flips over and it becomes a class 1 W pattern. And you can see there's the lowest close. It was above X. That X, well, that A, sorry, let's go to class 4. That A becomes that X. And what about this one? If it continues to be strong, remember, so class 1, what happens when CD comes to an end and it rolls over? Well, what are we going to have? We're going to have an M pattern. A is going to become X, and we're going to have an M pattern that looks like that again. Okay, so in a strong bullish trend, you're constantly switching or flipping between class 1, class 4, class 1, class 4. As soon as some weakness starts creeping in, what do we have? So what would we see? We'd have, let's say we've got a class 1, but let's say that rolls over and we now get D becomes C and our D starts coming down. Well, it'll flip to an M pattern. But what if that M pattern, in that M pattern, because that is now C, that's the new D. What if D now, we get a D close below A? It's a sign of weakness, because that what was resistance is now support is not being respected as support. And that's a sign of weakness. And you guys who've done my training know all of this, okay? It should not be new to you. We're just classifying it and making it a lot easier. And also, if you need to program this stuff, you know, with a computer, it's a lot easier to explain to a computer what to do. Right. So I hope now, just by that introductory explanation, you can see what I'm getting at is that we're looking still at the question, do we have a trend, yes or no? But now we're just taking our discussion around what the wave patterns look like and formalizing them so that we can start having, we can start taking these concepts, and they're like Lego blocks, remember? And start building slightly more intricate models with our Lego blocks. That's all we're doing. But the principles remain exactly the same. We're just formalizing the way that we look at that. So it's not as subjective, it becomes very objective. In fact, these are all now objects. Those of you who have done any computer programming, you get object-oriented programming is when you take a process and you turn it into an object. And you can sort of reuse it. And that's what I mean by Lego blocks. Okay, so worth bearing in mind as well, just want to talk about class 3 for a moment. We've spoken about class 1, class 2, and class 4 and class 5. Basically, all of those potentially are trending patterns. Class 1, class 4 is strong trend. Class 2, class 5 is weak trend. But that leaves class 3. What is a class 3 then? Well, clearly it's a range. Okay, but we might have a CD link because we don't know what D does. D might also be giving us a breakout. Okay, so if we get a higher close, let's say X here represents, and it might not, but remember with our HDC channels, we actually sometimes did have the top of our HDC channel being point X. In fact, it was the other way around. It was the bottom, wasn't it? So let's just go there. So let's say, you know, we were looking earlier at that range on the chart, and we saw that the bottom of our HDC channel, there was no lower price point looking at the preceding 13 candles, and therefore that was the bottom of our HDC channel. But what if we got a breakout? So they were all class 3 patterns, those. Could even be a class 6 pattern, but as soon as you get a breakout, D closes below the HDC channel, which we're assuming is point X. That's important. You need to know that. Okay, it's still a class 3 pattern, but it's not going to remain one. The next pattern will not be a class 3 pattern. So if D is a breakout and that becomes X, what have we got? As soon as we get a new wave starting here and the D becomes C and our D point starts moving up, what do we have? Well, first of all, we have a W pattern. What kind of W pattern? Well, it has to be either one of these. basically. So depending, but you know, which it is. Sorry, let me just go back to this. I don't want to confuse things. So this would have to be a class 4 or class 5 pattern. Would look like that. Okay, so if D started moving up with a bearish breakout, and we started seeing D move up, so that lowest point became C, becomes a W pattern, becomes a class 4 initially, but if it goes and closes above A, we'd be over here, it's a class 5. Either way, it's trending. Yep. So that's the theory behind it. It's not a lot. I hope you can see that. But when it comes to the practical application of it, that's a slightly different story. Then we start looking at all sorts of other possibilities. We've just looked now at how they flip from one to the other. But what we haven't even started looking at yet is, well, what about, well, maybe we've just started looking at it when we start, let's say, get a class 3 pattern, which turns into, let's say, class 3 M pattern, turns into a class 4 W pattern. What do we do with that? And that's just on a single time frame. What about when we start looking at these patterns across multiple time frames? And that's what I want to do in the next session. So fortunately, I've managed to stay in line with my expected time frame here. So let's go and have a quick look at some of the questions. If there's anything, I just want to spend time just clarifying any of these points that I've made now. So if there's other questions, then I won't necessarily look at answering them now. Oops, I shouldn't have done that. Okay, we've spoken to that. Nivek, volume, unfortunately, not so much because, well, it depends on the broker. If you've got a really good broker, then it can be indicative of what's happening in the market. But unfortunately, because we don't have a centralized market, the volume number is not representative of the true volume. It's the volume that your broker has. It's not the volume in the market. Barbara Ann is struggling with candles that close both a higher high and a lower low. Yes, I can do that, no problem. So that would be like an engulfing candle. So we can check that out. If we don't do it today, then we'll do tomorrow. I see you are signed up for tomorrow. Greg's asking, what's the main difference between liquidity provider and a broker? Okay, so a broker is supposed to facilitate the trade. They are not supposed to be a counterparty. A liquidity provider will always be a counterparty. Now, unfortunately, especially in the Forex market, a lot of brokers are also your counterparty, in which case there's a conflict of interest. And that's why, folks, I have got your broker selection guide in the academy so that you will never, or you will always make sure that your broker is the right broker. Over 90% of brokers out there are actually crooks. In the UK, the FSC in the UK determined years ago that over 90% of brokers act against the interests of their clients. Nothing's changed, unbelievably. Well, maybe not unbelievably, because that's the world we live in. So just recognize that. And so a broker, really, their job is simply to find that counterparty for you. Their systems are designed to make sure that they have counterparties ready, able and willing to take the other side of your trades. Same with, if you buy and sell a house, you go to an estate agent. The estate agent is a broker. They're there to find you a counterparty and to facilitate the deal going through. They're not supposed to have any interest in either side of the trade itself. So be very careful with what broker you use. Use the selection guide, or of course, it's pretty simple if you are using the funded trader program, because your investors determine who the broker is. Yes, Greg, it will be in the academy. So this is really just me getting into, we're getting you folks up to speed as quickly as possible. We've already got the WM training there, but there will obviously be quite a lot more stuff coming out in the academy as it is completed. Jared, we're trying to trade a potential class one. Oh, we'll talk about that. We're going to get to that. Good question, but you're jumping the gun. All right. All right, folks, it is now officially time for a short lunch break. I hope that this is something that you're finding useful. But we will start looking at practical examples on the chart and walking through that afterwards. And I'll also be looking then at taking this to the multiple time frames. So let's do that and reconvene, let's say just after the half-hour mark. So for those of you on Central European, Central African time, it is now just before midday. So in about 35 to 40 minutes, we'll start again. So if you think of any other questions, please also pop them into the comments. See you then.